Hello everyone, and welcome back to the channel. Today, we're diving deep into the global financial markets. And let me tell you, things are getting interesting. On the surface, you might see some positive signs. Stock markets are showing resilience, and some inflation numbers seem to be cooling off. But if you peel back the layers, a much more complex picture emerges. It feels a bit like walking on a tightrope, doesn't it? On one side, we have central banks hiking interest rates to fight inflation, which puts a major brake on economic growth. On the other side, geopolitical tensions and supply chain disruptions are still sending ripples through the system. These are powerful, opposing forces, creating a lot of uncertainty. So, what does this all mean for us? It signals that we're moving away from the era of easy money and predictable growth that we've known for over a decade. We're transitioning into a new economic reality. This new world will likely be defined by higher volatility and a greater need for a strategic, careful financial planning. It's no longer about just riding a rising wave. It's about navigating choppy waters. The key takeaway here is that the old rules might not apply anymore. We need to stay informed, be adaptable, and think critically about where we put our money. This isn't a time for panic, but it is a time for preparation and smart decision-making. We're entering a period where understanding the underlying pressures in the market is more crucial than ever. Thanks for tuning in. If you found this analysis helpful, make sure to hit that like button and subscribe for more insights into our changing financial world. See you in the next video. Hey everyone, welcome back to the channel. Today, we're diving deep into the global financial markets. It's been a roller coaster, right? From Wall Street to Shanghai, a lot has happened, and we're here to break it all down for you. Let's start with the big picture. We've seen some major central banks, like the Federal Reserve, signaling shifts in their interest rate policies. This is huge because it affects everything from your mortgage rates to the stock market's mood. Higher rates can slow down inflation, but they also might cool off economic growth. It's a delicate balancing act, and every investor is watching closely. Now, let's talk tech stocks. The tech sector has been on a wild ride. Companies that were darlings just a year ago are now facing some serious headwinds. But on the flip side, we're seeing incredible innovation in areas like artificial intelligence and green energy. These sectors are attracting a ton of investment and could be the big winners in the long run. It's a reminder that even in a tough market, there are always opportunities, if you know where to look. Shifting gears to international markets, Europe is dealing with its own unique set of economic challenges, particularly around energy costs. Meanwhile, emerging markets in Asia are showing some surprising resilience. Economies like India and Vietnam are growing fast, powered by strong domestic demand and a young, dynamic workforce. Keeping an eye on these regions could offer some interesting diversification for your portfolio. So, what does all this mean for you? The key takeaway is that the global economy is in a state of transition. Old patterns are breaking, and new trends are emerging. It's more important than ever to stay informed. Diversify your investments, and think long-term. Don't let short-term volatility scare you away from your financial goals. Instead, use it as a chance to learn and adapt. Thanks so much for tuning in. If you found this analysis helpful, don't forget to hit that like button and subscribe for more insights. Drop a comment below and let me know what market trends you're watching. See you in the next video. As pressure continues to build across the global financial system, attention naturally shifts toward currencies, especially the US dollar. The dollar sits at the center of global finance, and its behavior often reveals stress long before stock markets react. During periods of uncertainty, demand for the dollar tends to rise, not because conditions are healthy, but because global debt, trade, and reserves are still largely tied to it. A strengthening dollar in this environment is often a warning signal rather than a sign of strength. A strong dollar tightens financial conditions worldwide. Emerging markets struggle to service dollar-denominated debt. Global trade slows, and liquidity becomes harder to access. At the same time, inflation continues to erode purchasing power, creating a difficult balance for policymakers. Central banks face an impossible choice: support currencies by keeping rates high and risk slowing growth further, or cut rates to stimulate economies and risk undermining confidence in money itself. Currency markets tend to react faster than equities because they directly reflect trust. When investors begin questioning the stability of monetary policy, exchange rates move first. History shows that prolonged currency instability often comes before broader market repricing. Stocks may remain elevated for a time, But currencies quietly signal that something is changing underneath the surface. Inflation expectations add another layer of complexity. Once people believe prices will continue rising, behavior changes. Saving becomes less attractive. Speculation increases, and volatility accelerates. These shifts do not happen overnight, but they compound over time. When confidence in purchasing power weakens, capital begins searching for alternatives. This is where real assets enter the conversation. Gold and silver historically respond not to headlines, but to currency stress and declining trust in paper systems. They do not rely on promises or policy credibility. Instead, they represent scarcity and preservation. When money itself becomes uncertain, investors instinctively look for assets that exist outside the financial system. Capital rotation during these phases is subtle. It does not arrive with loud announcements. It moves slowly at first, then suddenly accelerates once a tipping point is reached. By the time most investors notice, prices have already adjusted. This is why currency behavior is so important. It connects debt, liquidity, inflation, and confidence into one signal. As this cycle unfolds, the stability of money becomes the central question. When currencies lose consistency, every other asset must reprice around them. This is not a theory. It is a pattern repeated throughout financial history, and it is why watching currency markets today provides critical insight into what may come next. Hey everyone, welcome back to the channel. Have you ever felt like the market is walking on a tightrope? One day it's soaring, the next it's shaky. Well, you're not wrong to feel that way. We're likely in what's known as the late stage of the financial cycle, and things can get pretty wild. Think of it like the final act of a long play. The energy is high, the drama is intense, and nobody knows exactly how it will end. So what does this late stage cycle actually look like? Typically, we see economic growth starting to slow down. Central banks, like the Fed, might be raising interest rates to cool off inflation, which can make borrowing more expensive for both companies and individuals. Corporate profits might start to look a little less stellar, and you'll hear the word recession being whispered more and more. This uncertainty often leads to increased market volatility. The big swings we're seeing, that's the market reacting to every piece of news, trying to figure out what's next. It's like a roller coaster, and it can be a nerve-wracking ride if you're not prepared. But here's the good news. You don't have to just sit and watch. There are smart ways to navigate this. First, let's talk about your portfolio. Diversification is your best friend right now. Don't put all your eggs in one basket. Instead of just holding high-growth tech stocks, consider adding some more defensive assets. Think about sectors that people rely on no matter what the economy is doing, like consumer staples, companies that sell food and household goods, or healthcare. These tend to be more resilient during downturns. Bonds can also act as a great stabilizer when stocks are volatile. Next, cash is not trash. Having some cash on the sidelines isn't a sign of fear. It's a strategic move. It gives you the flexibility to jump on opportunities when high-quality assets go on sale, which often happens during market corrections. Building up a solid emergency fund is also more important than ever. This protects you from having to sell your investments at the worst possible time if an unexpected expense comes up. And finally, stay informed, but don't panic. It's easy to get swept up in the daily news cycle and make emotional decisions. Stick to your long-term plan. Remember why you invested in the first place. History shows that markets eventually recover and go on to reach new highs. The key is to have a strategy that allows you to stay in the game. By being defensive, staying liquid, and keeping a level head, you can not only survive this late-stage cycle, but position yourself for future success. Thanks for watching, and if you found this helpful, make sure to like and subscribe for more insights. See you next time.